November 9, 2023, Berlin. A loaf of bread costs 200 billion marks. The woman ahead of you pulls out a wheelbarrow, not to carry groceries, but to carry enough cash to pay for milk. By the time you reach the front of the line, the baker crosses out the price and writes 250 billion. The currency lost 30% of its value, while you stood in line for 12 minutes. This isn't dystopian fiction, this was the Weimar Republic, and it's happened again and again. Venezuela, 2018, eggs cost 7 million bolivars. Zimbabwe, 2008, a bus ticket required a $100 trillion note. Lebanon, 2023, the currency lost 98% in 4 years, turning doctors into porters overnight. I'm Stanley Druckenmiller. I made George Soros $1 billion in a single day shorting the British pound. I've survived 6 currency crises, and I'm going to show you exactly which 5 assets survive when paper money becomes worthless, and which popular investments go to absolute zero. Here's the thing that keeps me up at night. It's not if your currency will fail. Historically, it's when. The average lifespan of fiat currency is 27 years. The dollar's been off the gold standard since 1971. Do the math. By the end of this video, you'll know exactly which 5 assets survived when empires burned. You'll see my actual portfolio allocation, the exact percentages. And soon I'll reveal why I hold 20% in one asset that central banks can't print. But first, understand this. Currency collapse follows a pattern. It's mathematical, predictable. Stage 1, the government spends more than it collects. Stage 2, it prints money to cover the gap. Stage 3, the currency loses purchasing power. Stage 4, people flee to alternatives. Stage 5, complete collapse every single time. Weimar Germany went from 320 marks per dollar in mid-1922 to 4.2 trillion by November 1923. Venezuela's bolivar went from 10 per dollar to over 1 million in a decade. Lebanon's pound collapsed from 1,500 to 89,000 in 4 years. Same pattern, same stages, same outcome. So what survived? Let me show you. Asset number 1 is the most obvious, and yet most people still don't own it. Precious metals, gold, silver, assets governments can't print and central banks can't debase. Here's the brutal math. During the Weimar collapse, if you held paper marks, you lost everything. 100%. Total wipeout. If you held gold, you maintained purchasing power entirely. An ounce of gold bought the same basket of goods before, during, and after the hyperinflation. The currency changed. Gold didn't. The same pattern occurred in Zimbabwe. When Mugabe's regime printed the 100 trillion note, anyone holding gold was protected, same in Venezuela. While bolivars became worthless, gold retained value. We're seeing it right now in Turkey. In late 2024, gold deposit accounts at Turkish banks surged from 1.36 trillion lira to 2.72 trillion in a single quarter, a doubling in 3 months. Why? Because Turks see the pattern. They're fleeing to the only asset that survived every collapse in human history. Here's what gold critics miss. Gold doesn't need to do anything. It doesn't need earnings or dividends. Its entire function is to not be debased. When fiat currency supply explodes, purchasing power collapses. Gold supply can't be arbitrarily expanded, so it becomes relatively more valuable by default. Now let me be honest. During 2008, gold crashed initially when liquidity froze. But once dust settled, it rose 166% in 3 years. Silver rose 448%. During 1970 stagflation, gold fell 50%, then surged 440%. Pattern recognition. The mechanism is simple. Precious metals are insurance against monetary system failure, not speculation, insurance. You hold them because they preserve purchasing power when everything else burns. My allocation, 20% in gold and precious metals. I don't hold gold bars. I hold gold mining stocks. Barrick Gold, Newmont, Agnico Eagle. Why miners? Leverage. Gold up 20%, miners up 60 to 80%. Plus I hold silver through First Majestic and Pan American Silver. In 6 minutes I'll reveal the Venezuelan stock that rose 3,400% during collapse. But first, the escape valve everyone needs. Asset number 2, foreign hard currencies. When your domestic currency dies, the escape valve is holding someone else's stable money. Let me take you to Beirut, October 2019. You're a nurse. You've saved $50,000 over a decade. The Lebanese pound is pegged 1,507 per dollar, rock solid for 22 years. Then the peg breaks. August 2019, black market rate hit 1,600. April 2020, 3,000. March 2021, 14,000. By 2025, 89,000. Your 50,000 is now worth $562. You lost 98% while the nominal number stayed the same. But your colleague kept savings in US dollars, physically, in cash, outside banks. She maintained 100% purchasing power. Not because the dollar was magical, but because she held a currency that wasn't collapsing. This pattern repeats everywhere. Zimbabwe dollarized before government made it official. Ecuador did the same in 2000. El Salvador in 2001. Panama since 1904. Venezuela right now uses dollars for major purchases. Argentina buys property in dollars. Cambodia ATMs dispense dollars. This isn't policy, it's survival. When domestic currency fails, rational people switch to stable foreign currency. The government can mandate all at once. People vote with their wallets. The lesson is clear. Access to foreign currency during crisis is complete protection. A person holding dollars during Lebanese collapse maintained wealth. A person holding pounds lost 98%. That's not volatility. That's the difference between survival and annihilation. In hyperinflation, the poor get poorer, but the middle class gets erased because the rich already own assets. The poor have nothing to lose. But the middle class, their entire life is savings, salary, and a bank account. My strategy, 35% in cash and treasury bills, dollar denominated, earning 5% risk-free. People say cash is trash, you're losing to inflation. Wrong. Cash is optionality. Cash is power. When everyone else was forced to sell in panic, I have dry powder to buy assets at 20 cents on the dollar. In 2007, I moved to cash. Everyone called me an idiot. Then 2008 happened. I bought fire sales, made $260 million while everyone else got wiped out. Cash is not trash. Cash is the most valuable asset in a liquidity crisis. Would pause. If you're realizing everything you thought you knew about economic safety is wrong, hit subscribe. This channel is financial forensics. I show you the autopsies so you see patterns before they repeat. Now back to assets that survive when money dies. Asset number 3 is counterintuitive, productive equities, stocks. Ownership in real companies with real assets. Here's what blows minds. Venezuela's stock market rose over 3,400% in 2024. Caracas Exchange surged from 2,082 to over 6,000 in 9 days. Individual stocks went parabolic. Mercantile up 200%, CanTV up 219%, Banco Provincial up 171%. You might think, economy collapsing and stocks skyrocketing? Makes no sense. Wrong. Perfect sense once you understand what stocks are. A stock isn't paper. It's ownership in real assets. Factories, equipment, inventory, land. When currency collapses, nominal price rises to match inflation because assets haven't disappeared. Imagine a Venezuelan company worth $100 million. When exchange rate goes from 10 bolivars per dollar to 30, stock price rises from 1 trillion bolivars to 3 trillion. Not because company got more valuable, but because it takes more bolivars to equal the same dollars. But here's the critical distinction. Not all stocks survive equally. Only companies with revenue diversified away from collapsing economy maintain real value. A company earning 100% in bolivars sees real profitability collapse. A company exporting 50% receives dollar revenues directly. Bolivar costs decline while dollar revenues stay stable. Real profitability improves. Research on Latin America 1982, Mexico 1994, Asia 1998 confirms this. Exporters thrived, domestic only burned. The lesson: productive equities with international revenue aren't just survivors, Their beneficiaries. A domestic-only company is burned with currency. My holdings. Taiwan Semiconductor, Philip Morris, Coupang, multi-currency revenue, dollar pricing power, hard assets that can't be inflated away. In 2 minutes, I'll show you what went to zero. But first, the tactical asset for when banking freezes. Asset number 4, consumables and barter goods. When formal monetary systems fail, economic activity doesn't stop. It reorganizes around different exchange media. Post-World War II Germany, the Reichsmark was worthless. People traded goods for cigarettes. American soldiers bought cigarettes for pennies and traded them for goods worth exponentially more. Why cigarettes? Standardized, divisible, non-perishable, light, widely accepted. All properties of money except one. No government issued them. Black markets operated 24/7, trading everything with cigarettes as currency. Here's proof. When Red Cross packages injected hundreds of thousands of cigarettes into prisoner camps, it caused inflation in cigarette prices. Same mechanism as fiat printing. More cigarettes chasing same goods equals higher cigarette prices. Fast forward to Venezuela 2018. As Bolivar became worthless, Venezuelans bartered. Fishermen traded catch for flour. Items holding value included medical supplies, food, water, fuel, batteries, tools, anything with immediate consumption value. But limitation. Consumables get consumed, can't store long-term wealth. They're tactical, not strategic. I don't hold consumables in portfolio, but maintain physical stores of properties. Non-perishable food, water filtration, medical supplies, fuel. Not because I'm a prepper, but because in every collapse, having these meant you could exchange when banking froze. Asset number 5, agricultural land, the immobile store of value producing what humans can't live without. Food. During Great Depression, farmers had survival advantages. Gardens, orchards, dairy cattle, chickens. They could do without new clothing, but faced one constraint. Still had to pay taxes in cash. This plays out in every collapse. In Venezuela, agricultural landowners maintained capacity to produce food regardless of currency. Urban real estate owners faced tenants who couldn't pay rent. Land produces calories. Urban real estate produces rent in collapsing currency. Calories win. But agricultural land has vulnerabilities. First, illiquid. Can't move it. Can't quickly sell. If political circumstances deteriorate, you're stuck. Zimbabwe 2000, Mugabe seized farms by decree. No compensation. Output collapsed 60%. Value declined 75% in 1 year. Second, taxation. Can't hide land. Governments can tax it into oblivion. Third, export cropland superior to domestic only. Export crops sell for stable currency. Domestic crops sell for collapsing currency. I don't hold agricultural land because of liquidity and political risks, but I understand why others do. Now what goes to zero? Understanding failures is as important as knowing survivors. Number 1, fixed income securities in collapsing currency. Bonds, treasury notes, anything where you're creditor to failing state. Weimar bondholders lost everything. Argentina 2001 saw 70% haircut after years of legal fights. Fixed income securities are claims against collapsing currency. When currency collapses, claim dies. Number 2, savings accounts in domestic currency within failing banks. The Mies deposits lost 95% as pound devalued to 89,000 per dollar by 2025. Customers who saved in 2019 retained 2% purchasing power by 2024. Nominal amount unchanged. Value evaporated. Number 3, physical cash in failing currency. Weimar citizens with marks and mattresses lost everything. Zimbabwe cash worthless. Venezuela Bolivar has disappeared in real time. Being creditor to failing state equals 100% wealth destruction. So where are warning signs now? Pattern recognition only matters if you identify setup before execution. Iraq 70% monetary supply gone due to withdrawal restrictions. Dinar devalued from 1190 to 1750. Stage 3 behavior, Turkey gold deposits doubled in 1 quarter, fleeing to metals. Stage 4, substitution begun. Lebanon, 98% collapse. Banking insolvent. Stage 5, complete failure. And the elephant in room, United States, 38 trillion debt, 1.1 trillion yearly interest. More than military budget. Dollar reserves fallen from 80 to 65%. Same path as British sterling decline. 1913, Britain was world's biggest creditor. 40 years later, net debtor, dollar replaced sterling. Pattern visible if you look. Now I know what you're thinking. Stanley, you've predicted crashes for years. Always bearish. What if you're wrong? Fair question. Let me address directly. Yes, I've been early. 1999, I thought tech bubble would pop in 2000. Pop 2001. Year early. Cost me money. Hurt, but I survived. When crash came, I was positioned to profit. Being early isn't being wrong. Early means you preserve capital and you're ready when turn comes. Wrong means you blow up and you're not around to play next hand. Maybe I'm early again. Maybe crash doesn't happen until 2027. But I'd rather be 6 months early and safe than 1 day late and bankrupt. Cost of being wrong if defensive. If I'm in cash earning 5% and market goes up 10%, I miss 5% gains. Annoying but not fatal. Cost of being wrong if fully invested. If leveraged. If in high-risk assets. When crash hits, catastrophic. You lose 30, 40, 50% and don't recover for years. Risk management isn't maximizing gains. It's surviving to play another day. Right now, survival more important than gains. My portfolio is brutally simple. 5 buckets. Bucket 1, cash and treasury bills, 35%. More than 1/3 in cash equivalents, earning 5% risk-free. Bucket 2, short positions, 25%. Shorting zombie companies with high debt and low cash flow. Commercial real estate, regional banks, biggest short, 15% input options on QQ NASDAQ 100 ETF. Bucket 3, gold and precious metals, 20%. Mining stocks for leverage, silver for volatility, insurance against system failure. Bucket 4, energy, 10%. Oil and gas, you can't print oil. Fed can print dollars, but not crude. Bucket 5, defensive consumer staples, 10%. Procter & Gamble, Coca-Cola, Johnson & Johnson. Even in depression, people brush teeth and buy toilet paper. 5 buckets, 100%. Notice what's missing. No tech stocks, no crypto, no memes, no IPOs. Not designed to get rich quick. Designed to survive what's coming and profit when assets go on sale. Brutal truth. Currency collapse isn't hypothetical, it's historical norm. Average fiat lifespan 27 years. 99% of all currencies that existed are gone. Question isn't if your currency fails, but whether you'll be positioned to survive. 5 assets survived every collapse since 1923. Precious metals, universal store of value. Foreign currencies, the escape valve. Productive equities with exports, beneficiaries of devaluation, consumables and barter goods, tactical liquidity, agricultural land, calorie generator, assets that went to zero, fixed income and domestic currency, credit wiped, savings accounts and harassing currency, purchasing power annihilated. Lesson isn't abandoning domestic assets or becoming doomsday prepper hoarding gold. Lesson is genuine diversification requires holding different value forms, responding differently to monetary failure. Portfolio entirely in single country equities faces catastrophic risk if that country experiences currency collapse. Portfolio entirely in bonds denominated in collapsing currency gets destroyed. Genuinely diversified portfolio includes precious metals as insurance, foreign currency assets protecting against currency-specific risk, productive equities with international revenues, possibly real assets in stable jurisdictions. Contemporary warnings in Iraq, Turkey, Lebanon suggest currency crises remain live possibility. US dollar remains stable, but historical record shows this status can't be taken for granted indefinitely. Most prudent approach isn't panic, it's recognizing pattern and positioning accordingly. Sufficient diversification across asset classes and jurisdictions means no single failure destroys purchasing power entirely. History has answers.